The bear case for Admiral Group is centered on the inevitable softening of the insurance cycle, the impact of persistent claims inflation on margins, and the risks associated with its heavy reliance on the UK motor market and its reinsurance partners. The softening cycle and pricing pressure. The primary concern for the bear case is that the era of record-breaking margin expansion may be coming to an end. After several years of aggressive rate increases, the UK motor insurance market has entered a softer phase. Car insurance prices have been falling for approximately 18 months leading into mid-2025, driven by softer inflation and a fierce competitive marketplace. In H1 2025, Admiral reported a 6% reduction in UK motor turnover compared to H1 2024, as rate reductions and a shift in sales mix from new business to renewals led to lower average premiums. While Admiral's disciplined approach means it grew its customer base by 5% during the period, the burn cost dynamics, the relationship between premiums and the actual cost of claims, are becoming increasingly unfavorable.
Analysts at Goldman Sachs downgraded Admiral to a sell in late 2025, specifically citing concerns that the expected inflection in pricing trends failed to materialize. Goldman Sachs anticipates a 17% drop in Admiral's earnings per share throughout 2026 as the company laps periods of frequency improvements and faces rising claims inflation. The market consensus for 2025 revenue suggests a 5.4% decline compared to the previous year, highlighting a significant reversal from the historical 30% growth rate. While consumer premiums are falling, the underlying costs of servicing those claims remain high. Bearish observers point to a global surge in industrial metal prices and persistent chip shortages as peripheral risks that could drive up the cost of vehicle repairs. The increasing complexity of modern vehicles, particularly those equipped with advanced driver assistance systems and electric powertrains, means that even minor accidents can result in high repair bills. EY's analysis of the UK motor insurance market projects a deteriorating outlook for the industry's net combined ratio, NCR. 2024, 97%, profitable status. 2025, 101%, forecasted break-even status. 2026, 111%, forecasted loss-making status.
After a profitable 2024, the sector is expected to only break even in 2025. For 2026, the forecast is even more dire, with the market expected to become loss-making with an NCR of 111%. In such an environment, the pressure on Admiral's margins will be intense. Even if Admiral maintains its structural advantage of 8 to 10 points better than the market, a market-wide NCR of 111% could push Admiral's own combined ratio above 100%, erasing underwriting profits and forcing the group to rely solely on investment income and fees. Admiral's capital-light model, while a strength in a growth environment, represents a significant vulnerability if reinsurance conditions change. The group relies on external partners to provide quota-share reinsurance for 75% of its primary motor risk. This model results in a significant portion of underwriting profit being ceded to third parties. In the 2025 renewal cycle, the cost of securing this reinsurance increased by 7% due to global market hardening. Any further reduction in reinsurance capacity or continued price increases from partners could force Admiral to hold significantly more capital. Estimates suggest that a significant reduction in reinsurance support could require an incremental £150 to £300 million in capital, which would place immediate pressure on the group's return on equity and its ability to sustain its high dividend payout ratio.
The regulatory environment continues to be a source of uncertainty. The FCA's General Insurance Pricing Practices intervention was designed to end price walking and ensure that renewing customers are not charged more than new customers for the same risk. While this has made the market fairer for consumers, it has also fundamentally changed the competitive dynamics, increasing the importance of accurate pricing at the point of renewal and potentially limiting the ability of insurers to recover from periods of high claims inflation through aggressive renewal pricing. In the long term, the rise of autonomous vehicles presents a structural risk to the entire motor insurance industry. As automation takes over more driving tasks, the frequency of accidents is expected to fall, which could lead to a shrinking profit pool for traditional insurers. Furthermore, the shift in liability from the individual driver to the vehicle manufacturer could see a move toward product liability insurance, a segment where Admiral does not currently hold a dominant position.
The bull case for Admiral Group is predicated on the durability of its three core competitive pillars: proprietary data analytics, a capital-light reinsurance model, and the execution of its beyond motor diversification strategy. At the heart of Admiral's model is its ability to price risk, While traditional insurers often rely on broad demographic categories, Admiral has spent decades refining proprietary pricing algorithms and risk models that leverage granular behavioral data. This data-first approach has resulted in a loss ratio that is estimated to be 14% lower than that of its closest UK competitors. A significant component of this advantage is Admiral's investment in telematics. By the end of 2025, the group had captured data from 1.2 million active telematics users, allowing for high-fidelity behavioral pricing that rewards safe driving and penalizes riskier behavior. This granular understanding of risk does more than just lower the loss ratio. It improves customer retention. Behavioral pricing has contributed to a 5% improvement in renewal rates across the core motor segment, as low-risk drivers are less likely to find better rates elsewhere.
The mathematical superiority of Admiral's underwriting is further evidenced by its insurance service margin, which expanded to 18.8% in H1 2025, compared to 12.6% in the prior year period. This margin expansion is a direct result of the group's disciplined approach to pricing and growth, where it remains willing to sacrifice volume to maintain profitability. Admiral has consistently achieved a combined operating ratio significantly better than the industry average. In FY 2025, Admiral's COR was 87.5%, compared to a peer average of 96%. The second pillar of the bull case is Admiral's capital-light business model. Unlike many of its peers who retain the majority of the risk they write, Admiral cedes a significant portion of its primary motor risk to external partners through quota share reinsurance agreements. As of late 2025, management had secured reinsurance covering 75% of the UK motor business through 2027. This model provides several strategic benefits. Capital allocation. By ceding risk, Admiral reduces the amount of capital it is required to hold against potential losses. This enables the group to generate an exceptionally high return on equity, 57% in H1 2025, and return a large portion of its profits to shareholders.
Profit commission. Admiral earns profit commission from its reinsurers when the business it writes performs well. This serves as an additional revenue stream that is highly geared to underwriting excellence. Risk mitigation. The reinsurance partners absorb the volatility associated with large-scale claims, providing Admiral with a more stable earnings profile across different market cycles. The relationship with partners like Munich Re has been long-standing and is built on mutual trust in Admiral's data capabilities. This ecosystem allows Admiral to scale its business without the traditional capital constraints that hinder growth for many insurance firms. While motor insurance remains the core profit engine, accounting for approximately 75% of total group profit in late 2025, the bull case is increasingly supported by the rapid growth of Admiral's newer business lines. The group's Beyond Motor strategy aims to replicate its motor insurance expertise in distribution, pricing, and claims management across other segments. The household insurance business is the most mature of these initiatives, achieving a 30% CAGR since launch and underwriting 2.1 million risks by mid-2025. In H1 2025, the UK household segment more than doubled its profit to £25.2 million, driven by both customer growth and a strong combined ratio. The acquisition of renewal rights from RSA's More Than brand significantly accelerated this growth, accounting for two-thirds of the segment's expansion between mid-2024 and mid-2025.
Similarly, the travel and pet insurance lines have shown momentum. Travel insurance has delivered over 50% CAGR since inception, underwriting 1.1 million risks as of H1 2025. The pet insurance segment, though newer, is growing at a 5x CAGR and is rapidly approaching break-even. Admiral's goal is to become a top 3 player in all 3 lines, household, travel, and pet, with market shares of at least 10% in the medium term. Admiral Money represents a high-potential growth lever within the group's diversified portfolio. By leveraging its existing insurance customer base, Admiral can acquire personal loan customers at a significantly lower cost than traditional banks or pure-play lenders. The gross loan balances reached £1.28 billion in H1 2025, a 25% increase year-on-year, while segment profits soared 139% to £16.3 million.
Part 2. Overview of the financial performance for Admiral Group. The fiscal year 2024 delivered a profit before tax of £839.2 million, a 90% increase over the £442.8 million reported in 2023. This surge in profitability was primarily driven by the earning through of significant rate increases implemented in previous years to combat rampant claims inflation. The momentum was sustained into the first half of 2025, with results that exceeded market expectations. Detailed financial performance indicators for the 2024 fiscal year and the first half of 2025 include: Group profit before tax reached £521 million in H1 2025, a 69% increase from £307 million in H1 2024. Earnings per share reached 132.5p in H1 2025, up 72% from 76.9p in H1 2024. Group turnover grew 28% to £6.15 billion in FY 2024 compared to £4.81 billion in FY 2023, while turnover for H1 2025 remained flat at £3.10 billion.
Insurance revenue increased 18% to £2.47 billion in H1 2025, compared to £2.09 billion in the prior year period. Return on equity improved by 20 points to 56% in FY 2024 and further reached 57% in H1 2025, a 12-point increase over H1 2024. Solvency ratio post-dividend stood at 203% in FY 2024, up from 203% in FY 2023, and was reported at 194% in H1 2025. While group turnover remained flat at £3.10 billion in H1 2025, insurance revenue climbed 18% to £2.47 billion, reflecting the higher earned premium from the 2024 underwriting year. The return on equity reached 57%, further solidifying Admiral's position as one of the most capital-efficient insurers globally. However, the flatness in turnover signals the onset of a more competitive pricing environment, as average premiums in the UK motor segment began to recede.
A breakdown of segment performance for the first half of 2025 includes: UK Motor reported a profit before tax of £559.3 million, a 56% increase from £358.9 million in H1 2024, supported by a customer base of 5.75 million vehicles. UK Household more than doubled its profit to £25.2 million from £11.3 million in H1 2024, with 2.14 million households insured. Travel and Pet reduced its segment loss to £0.1 million from £6.9 million in H1 2024, an improvement of 98%, with 1.41 million policies at period end. Admiral Money achieved a profit of £16.3 million, up 139% from £6.8 million in H1 2024. The international portfolio and strategic divestments. The international segment has historically been a mixed performer for Admiral Group. While the UK business has consistently delivered stellar results, the European operations have faced a tough market. The US exit, selling Elephant to J.C. Flowers.
A pivotal move in late 2025 was the completion of the sale of Admiral's U.S. motor insurance business, Elephant, to the private equity firm J.C. Flowers & Co. The transaction, which became effective on December 31, 2025, reflects a decision to exit a market where Admiral lacked the necessary scale to achieve significant economies of scale. Before the sale, the U.S. operations remained a persistent drag on the group's overall efficiency. With a turnover of approximately $250 million, Elephant held a market share of less than 0.5% in its active states and reported a combined ratio of 102%. The high customer acquisition costs in the North American market represented a 15% drag on international segment margins. By divesting Elephant, Admiral can now focus its resources and management attention on the opportunities it sees in the UK and mainland Europe. Following the U.S. divestment, the international focus shifts to France, Spain, and Italy.
Valuation metrics benchmarking. Comparative metrics for early 2026. Price-to-earnings ratio, normalized. Admiral trades at 9.69 to 10.39x, compared to Aviva at 14.85x and a sector average of 10.1x. Price-to-book value. Admiral stands at 5.83 to 5.9x, significantly higher than Aviva at 2.04x and the sector average of 1x. Return on equity. Admiral delivers 57 to 67.5%, well above Aviva's 16.86% and the sector average of 17.4%. Return on assets. Admiral reports 10.88%,
significantly outperforming Aviva's 0.40% and the sector average of 1.28%. Dividend policy. Admiral has maintained dividend payments for 21 consecutive years and currently offers a substantial yield. The dividend policy is to pay 65% of post-tax profits as a normal dividend, supplemented by a special dividend of excess capital not required for solvency buffers or share buybacks. For FY 2024, the total dividend was 192.0 pence per share. The interim dividend for 2025 was declared at 115.0 pence per share, a 62% increase over the 2024 interim dividend, reflecting an 88% payout ratio. The recent sell-off in the stock has pushed the prospective yield toward 8.43%, a level that many yield buyers find excessive for a company with Admiral's high-quality balance sheet. However, if the bear case of a 17% EPS drop in 2026 manifests, the absolute dividend per share will likely fall, even if the yield remains high relative to the share price.
Conclusion. The bull case is fundamentally structural. Admiral is a better-run machine than its competitors. Its use of data to lower loss ratios and its capital-light model to boost ROE are durable advantages that do not disappear just because the market gets tougher. The successful diversification into household, pet, and travel insurance provides the group with a broader platform for growth and a hedge against motor-specific downturns. However, the bear case is fundamentally cyclical. No amount of operational excellence can completely insulate an insurer from a market where prices fall by 10% while claims costs rise. The EY forecast of an industry-wide NCR of 111% for 2026 is a sobering reminder of the fierce competitive environment. Investors in Admiral must weigh whether the company's structural alpha, its ability to consistently outperform the market by 8 to 10 points, is enough to sustain earnings growth when the market as a whole is in a downturn.